Hope you're doing well, guys. Shiv Haria here from Lifestyle Property People, and really looking forward to tonight's topic, which is how does the increasing Bank of England base rate affect the property market? So I've been having literally hundreds of conversations over the last couple of weeks about this exact topic, and we all know that since the beginning of this year, base rates have been increasing quite considerably and quite quickly. And what I wanted to do was, because not a lot of people actually understand the mechanism for how the base rate impacts the property market, and also why is the base rate increasing in the first place, I thought I'd start from kind of scratch, start from the basics, and help you understand the sort of step-by-step process. Just for those who don't know, I studied economics at university, and so I can sort of piece those bits together and understand how they fit together. And hopefully by the end of this topic, you'll also be able to piece those things together. So thanks for those of you who have joined me. I think we'll probably go on for about 25 minutes or half an hour. And if you've got any questions or anything like that, just ask me on here and I'll see them pop up at the bottom and then I can answer them. So the first things first is let's start with the first most important question. You know, what is this base rate, and what is the base rate and why is it different for the interest rate? The base rate is basically the rate at which lenders borrow money from the Bank of England. So the Bank of England is the central bank in the UK. It's the equivalent of the Federal Reserve in the US or the European Central Bank, the ECB in Europe. And the Bank of England basically lends money out to lenders, and that's the money that's the rate at which they borrow at. Now, of course, if the rate at which they borrow money at goes up, then ultimately the rate at which they can then lend the money out to other people like yourselves or myself will also increase. So that is exactly what the Bank of England base rate is. And how much is it at the moment? We know at the moment we're looking at 4.75% as of last month, I think it was. And we're also thinking that in the very near future, so we're thinking probably in a couple of days' time, that base rate is going to increase again. Now, this is comparing to, say, for example, the beginning of last year, where it was almost zero. So it's come up quite significantly, quite quickly. And normally this kind of increase usually ends up taking somewhere in the region of 3-4 years to get to. And we've done it in sort of about 12 to 15 months. So that's why that's what's been happening with the Bank of England base rate. However, one thing to realise, if you don't know already, is that back in the 80s, it was in the region of 15%. So although we're up at the kind of nearly 5% mark, actually, in general terms, across time, it has been much, much higher. And for those of you who are old enough to remember, you'll remember the times when it was in the kind of 12-15% range, which is, double-digit base rate. Who sets the Bank of England base rate? So there's basically a committee of people, and they are appointed, and they're called the Monetary Policy Committee. And there's 9 of them, and their job is to set the Monetary Policy Committee. Their job is to set the Bank of England base rate. And why does it actually change in the first place? What's the point of going up and down on the Bank of England base rate? It's basically just to control inflation. So we have inflation in the world, and I'm going to go on in a second to understand, to explain exactly what inflation is. But the job of the base rate is to control inflation. So that's the kind of brief summary of kind of the Bank of England base rate and what it is and what it does. And then now let's go on to inflation. So what is inflation? Now, you'll all know that when you go to the shops, things today are not what they used to be 5 years ago, not what they used to be. Test called the Freddo test. If you remember, Freddos used to be 10p or something like that. Even 1p sweets are probably 5p now. So the inflation is basically the general increase in the price of goods and services. Goods and services being the things that you can buy. And how much is it at the moment? It's currently, as of April 2023, it's 8.7%. And for those of you who remember, or if you read the news, you'll know that it used to be up at double digits, so past 10%, 11%, something like that. It then came down to 10.1%, and then it's now 8.7%. So it increased very, very sharply and has now started to come down. When I say increase very, very sharply, where did it increase from? Where has it come from? Well, we know that the inflation rate is set. The Bank of England set a target of 2%. So they want inflation to be at 2%. So they want every year prices to be increasing by 2%. So that means if something costs £1 today, then in 1 year from now, it should cost £1 and two pence. So there's a 2% Bank of England base rate target. But the question, of course, comes back to, well, why does the Bank of England have a base rate target in the first place? Why not just let it do what it's going to do? And the whole point around this is to create stability. Why are we trying to create stability? We're trying to create stability for the government themselves, but also for business owners and also for ourselves as consumers. You know, if something costs £10 today and we don't know whether it's going to cost £8 tomorrow or £10 and 2 pence or £20 tomorrow, we don't know how to make our spending decisions. We don't know whether to buy today or to wait until the future. But if we know that there's going to be a small increase every single year, just 2%, 2%, 2%, then that means that will help us to make our spending decisions more wisely. And how does the UK compare to the rest of the world and rest of the Western economies? Well, at the moment, I'm just reading some notes that I've got over here. The US is currently at about 4% inflation. Europe is currently at about 6.1% inflation. We're a bit higher at the moment at 8.7% inflation. But what we're trying to say is that actually some of these other economies, Western economies around us, they're a little bit lower and they may well be a little bit further ahead in terms of their growth path. And so why is it so high at the moment? You know, what's caused inflation to increase so rapidly over the last couple of years? And ultimately, the answer to that question is threefold. The first is pent-up demand. So since COVID, because people were stuck at home and they had money in their banks, but they couldn't actually spend it, we couldn't get the goods. That means that people have actually had pent up the demand. They've got all this demand, they've all this stuff that they want to buy, and they've gone out now and been able to buy it. So there's been a huge increase in the prices of things because the demand for goods and services has increased. The second reason is because we've got the war in Ukraine, and I know that was a little bit ago now, but that's having a knock-on effect on energy prices at the moment because Ukraine was a big supplier and Russia is a big supplier of gas. So at the moment, energy prices are or were a lot higher than they are right now, and the way that they measure that is by looking at the wholesale gas prices, the wholesale energy prices, rather than just looking at kind of what you and I pay for our electric. So they look at the wholesale prices because that's obviously what companies buy, and then from that they can then ascertain exactly what to charge us. But ultimately, because of the war in Ukraine, it means there's been a reduction in the supply of energy, and if there's a reduction in the supply but the demand is still the same, then the price has to go up. So that's what happened over the last year or so. What we've also started seeing though is that's more or less come down to where we expected it to be. It's still higher than where we were say 2-3 years ago, but it is much more in line with where we expect it to be. So for some kind of off the top of my head stats, we went from say £100, we went up to say £200, so the price doubled, or even more than that, £250, and then that's now come back down to about £140, £100 and something along those kind of lines. And also, because food and fuel prices are increasing, the third reason is that if everything's going up in price, of course, what we're all going to do as people that have jobs, we're professionals, is we're going to think to ourselves, well, if we're not getting a pay rise, then we're actually getting poorer, because if we're not getting pay rise and everything else around us is going up in price, we are going to be actually getting poorer. So what we're going to do, of course, is go to our employer as soon as the time comes for a pay rise, and we're going to say, oh, you know, is it possible that we can get a pay rise? Or what we might do if we don't want to have that conversation is just start looking at other jobs that can give us a pay rise. And if that happens and people do get pay rises or they move to jobs that have a higher pay, then ultimately that creates wage inflation. Wage inflation is obviously just the general increase in the in wages. And as soon as there's wage inflation, that inflation then becomes entrenched in the economy. So if you've got, let's say, for example, we're talking about energy prices. You've got energy prices, obviously that causes everything to increase in price because you need energy to produce and transport all goods and services. So everything increases in price. But then when that energy prices comes down again, then you know that those prices are going to come down again as well. So they're not that sticky. They go up and down with the energy prices. However, when it comes to wages, because wages, it's very difficult. Let's say, for example, you've increased the prices of everyone, the wages of everyone by, say, 5% or 10%, whatever it might be. If you've increased it by 5%, next year you can't go back and say, actually, I'm going to give you a decrease in your wages. People don't accept that. It's very unlikely that that's going to happen. So as a result, as soon as we have wage inflation, the inflation becomes a bit more sticky. That's a technical term, actually. And what it means is it takes a little bit longer for that inflation to come down again. So that's what inflation is and what's happening in the economy, why we've had the inflation. And as I said earlier, the Bank of England base rate, the reason for it, that we have the base rate, and the reason that the Monetary Policy Committee is even trying to change the base rate, is to affect inflation and is to bring, in this case, inflation down, and in the past, maybe inflation up as well. So let's just work through then what happens if the Bank of England increases the base rate. I want to talk you through like the step-by-step process so you totally understand this. So basically, the first thing that happens is you have increasing mortgage repayments. So if somebody's on a mortgage for their house, they've got a house and they've bought it for £100,000 or whatever they bought it for, and they've got a mortgage, that mortgage has interest on it, of course. And that interest might be, say, 2%, 3%, 4%, whatever it might be. But if it goes from 2% to 3% or 2% to 4%, that interest element of your mortgage is going to increase. It's going to, in the case from 2 to 4%, your interest element is going to double. So if you were paying, for example, £800 in interest, you're now going to be paying £1,600 in interest a month. And this is quite a big increase. If you think, the average pay, for example, for somebody might be 30, 40 grand. So let's just assume that's, say, £2,000-3,000 a month. An £800 increase on a £2,000 salary is a huge increase, massive increase. What that obviously does is if people's having to pay more in interest, then their disposable income, the amount of income they have to use and to spend every day, starts to take a dip. The second impact is that increasing the base rate increases the cost of borrowing. So that means that if I want to go and apply for a loan, or if businesses want to go and apply for loans to grow, for example, then that cost of borrowing is going to go up. Again, the same way that the mortgage interest payments go up, the cost of borrowing goes up. And of course, if the cost of borrowing goes up, then what that actually means is that there's a reduction in the borrowing at the end of the day. Like, people not going to borrow at 20% when they could have borrowed at 5% yesterday. So they'll just wait, for example, until maybe the rates come down, and then they'll borrow when it's cheaper to borrow. The third impact of the Bank of England base rates increasing is that savings interest rates go up. So some of you will have seen this right now. If you look around at what kind of interest rates are available from savings accounts, even from your regular kind of savings accounts that you have in the bank, you're not even talking about like fixed deposit accounts or term deposit accounts. You're looking at kind of somewhere in the region of 3-4%. Now, a lot of people on this call will remember that those rates used to be at pretty much zero, 0, 0.1, 0.2, maybe if you were very, very lucky. But now we're talking about actually 2, 3, 4%, depending on the amount of money that you have. And that, of course, encourages people, rather than investing that money, they think, well, let's just put it into the bank because it's probably safer to keep it in the bank. And so currently, like I said, the rates are about 4% in some places, and that obviously encourages people to save. And all of this, the mortgage interest rates increasing, the cost of borrowing increasing, and the savings interest rates increasing, all leads to one thing, which is a slowdown. People stop spending. People start to save, and people stop spending. And that slowdown in the economy will, of course, reduce inflation. So if there's a slowdown in the economy, what it's basically meaning is that prices start to come down slowly and steadily. Then, once inflation has dropped, the Bank of England can then start to cut those interest rates again. And by cutting the interest rates, the opposite happens. So the mortgage interest payments come down, the cost of borrowing comes down, and the savings interest rates go down as well. And as a result, instead of saving and stopping their spending, people now start stopping the saving and start to spend more. So spending starts to increase. And of course, as spending starts to increase, then we start to get more inflation again. So as you can see from this kind of example, it's a bit of a balancing act. We've got inflation and interest rates. And if inflation is going up, then interest rates need to go up so that we can start to bring down inflation. But inflation comes down, we've now got to decrease the interest rates as well. so that we can stimulate the growth in the economy again. And the whole thing to remember is that this whole game that the Monetary Policy Committee are playing, and I say game in a way that it's moving levers around. This game that they're playing is just to maintain this 2% inflation target. And the reason for that, if you remember I said at the beginning, is all about making sure that we have steady growth, which will allow businesses and consumers like you and I to plan our expenditure, to plan our spending, to plan our investments. A stable environment is what they're after. So I just want to also work through what is a recession, and I don't want to send any cats running about like there's going to be a recession or massive recession or anything like that, but I just want to work through what is a recession and what the inflation rate and the interest rate has to do with inflation. We just said that it's a balancing act between the economy growing at say 2, 3, 4, 10% a year and kind of coming down at 2, 3, 4, 10% a year. And what we want to do is maintain this kind of 2% steady growth. But what happens is that if we, when we increase interest rates, it's not the case that the inflation rate starts to come down straight away. There's a bit of a lag. People are like, well, what's going to happen here? Are the Bank of England going to continue increasing interest rates? Is it going to go down? And so there's a lot of expectation that's built into these models as well. So, for example, if people expect that in the future the interest rates are going to come down, then that means that they may not stop their spending. They may continue their spending. Whereas if they expect that the interest rates are going to be high for some time, then they might think, well, actually, I don't want to spend anymore. I want to, make sure I'm saving some money because, there might be some hard times ahead. So what you've got to realize is whenever the Bank of England makes any announcements, whenever you see these things in the newspaper, they are there for a reason. They're there to send a signal to the likes of you and me to get us to act in a particular way. So, for example, when the Bank of England says that by the end of the year, inflation is going to be at 2.9%, it doesn't necessarily mean that they believe that it's going to be at 2.9%. It just means they're trying to say to us, look, guys, don't worry, it's going to be okay. Why are they saying that? Because they don't want us to worry. If we worry and we start to reduce our spending all of a sudden very quickly, then all of a sudden we're going to have a bit of a problem. Likewise, if we start to increase our spending very, very quickly, all of a sudden we're going to have a bit of a problem. So the Bank of England uses the signals that they get from the news, that they put out in the news, to effectively control our behaviour. That is ultimately what it is. So what is a recession? A recession is classified as 2 quarters of negative economic growth. What are quarters? 3 months. So let's say, for example, January, February, March, April, May, June. So once we've had 2 quarters, so half a year, 6 months of negative economic growth, that is classified as a recession. So for example, if we have 1 quarter of negative economic growth and then 1 quarter of positive economic growth, that's not classified as a recession. We have not gone into recession. And at the moment, if I am correct, we've kind of steered away from a recession. We've not had 2 quarters of negative economic growth. It remains to be seen whether that's going to continue. But again, not to scare you away, what we need to remember is that a recession, also known as a correction in the market, is not necessarily like the 2007, 2008, 2009 crash. It's not going to be like a massive crash in the economy. It could be, but a recession just means that there's a negative economic growth for a little bit. It could be that it's a very minor, minus 0.1%. Instead of being at 2% inflation, we're at minus 0.1% inflation. And so all of a sudden, if people make a big deal about it, then it becomes a crash and it becomes a big recession. Whereas if people go, oh, well, actually, it's not that big a deal, then we can then continue kind of growth afterwards. Remember, at the end of the day, this is all controlled about how people feel. The word that economists use is sentiment. So what is people's sentiment? What do they feel about the future? If people are feeling optimistic about the future, they'll spend more. If people are feeling pessimistic about the future, then they probably will save more. Like I said, in 2007 and 2008, there was a big recession, as I'm sure you're all aware, but that was caused by subprime mortgage lending. So that was caused literally because people were packaging up mortgages and selling them to other institutions, and no one really cared how it all worked, and there was a whole bunch of fraud that was involved in that case as well. The trend, though, is usually for there to be a big recession followed by a small recession. And usually this is kind of like, and again, not to quote anyone, but it's like in an 18-year cycle is what happens. So every time you have a big recession and then it kind of comes down a bit, and so your growth, recession, and then you grow again, and then you usually have a smaller recession. You usually have a correction. So it's really like big recession, correction, big recession, correction. Now, what I think we're going through right now is a bit of a correction. It's only a small thing. I don't think it's going to turn out to be a massive, massive thing. But, I can't read the future, so it remains to be seen. What we're trying to say is that we had the big recession in 2007, 8 and 9. And right now what we're talking about and what we're seeing is kind of more like the correction. And why does it work like that? Why do we have the big recession and then the small recession? What's the purpose of that? Well, actually, the reason why that follows that trend and where we continue to follow that trend is basically comes down to like how long humans live. So if you think you have someone who's, say, 25, 30, they're just at the age, they've come out of the world of education, they've come into the world of work, they've now invested some money, and they can now kind of start to see what's going to happen to that money. All of a sudden, the market starts to take off. It starts to go up, up, and up. And what they think to themselves is, oh my God, the market's going up, let's get involved. And so they put more money into the market. And more people put this money into the market. And because they're putting the money into the market, the prices keep going up. And of course, what happens is somebody one day goes, hold on a second, I don't know if this is going to keep going up. I better pull my money out. So they get scared and they pull their money out. And all of a sudden that continues like a trickle effect, and everyone starts to get scared and everyone starts to pull their money out. And as soon as everyone starts to pull their money out, that's when it crashes. So it goes down again. Now these people, what we're talking about is they were 25, 30 years old. Let's say they're 25 years old when it was going up. They're now sort of 32, 33, 34 years old. It's now come down for a little bit. So let's say it's come down for about 4 years, 32, 33, 34 years old, something like that. And then it started to go back up again. It starts to go back up again, and that could take another 5-7 years for it to go back up again. So we're now looking at someone who's 40, 42, something like that. If you look at someone who's 40, 42, of course, the next time round, when they go through a correction or fears of a recession, they're going to be a bit more careful because they know what happened the last time round. So because they know what happened the last time round, they're going to be a bit more careful. Everyone's going to be a bit more careful. And because they're a bit more careful, instead of having a massive crash, we're going to have a bit more of a correction, a stable or a quick stabilization of the market. So that then goes through the market, and now all of a sudden these people are like in their mid-50s. And of course, guess what's happening now? The new generation are coming through into the market. And as the new generation come through into the market, everyone starts piling in the market again. They've forgotten what it's like to, the 2007 and 8 crash, because we're now in 32. And all of a sudden, this market is going to keep investing, and then one day someone's going to say, hold on a second, I think this is too good to be true. They're going to pull their money out, and all of a sudden we're going to go through a big crash again. So that hopefully explains why we go through usually a big recession and then a sort of a bit of a correction rather than two big recessions following each other. And remember, like I said, that this is people have this perception that, recession is something to be fearful of. It's like this bad thing we should be not looking forward to. But actually, all it really is it's just, like I said, it's just 2 quarters of negative economic growth. We go through cycles in the economy. It goes up, then it goes down, and guess what happens after it goes down? It goes back up again, and no prizes for guessing what happens after it goes back up again. It goes back down again. That's just the way that it works. So I think that sometimes what we need to do as investors is to make sure that we're looking at the actual impact on our lives, really, rather than just getting caught up in the fear. I think a lot of people get caught up in the fear. Oh my God, there's a recession. I better be careful. I better put my money away. What we really need to understand is, and I say this to people often, are you still going to the restaurants? Yes, probably. Are you still buying what you used to buy? Are you still buying gifts and stuff for people? Yes, you probably are. Then in that case, then most people who are watching this, I'm sure, are probably in a half-decent position. They're in a good position, and what that really means is they're in a position where they can really capitalize on the market. They can capitalize on the opportunity about where the market is right now. And I'll go into in a second what that actually means for the property market, so we can talk about that. But ultimately, the thing that's stopping all this is that lenders get nervous. So when the lenders get nervous, then all of us, and no one wants to lose money. So what they do is they say, oh my God, well, we don't know because the interest rates are going up, so we better pull our lower rates and put out more, higher rates, so that other people, we're not getting caught, we're not getting stung by offering people rates that are too low. So they put out higher rates, and so the mortgage interest rates increase. So if the Bank of England base rates increasing, it causes a bit of a correction, and that leads to the kind of market that we're in right now, which is that mortgage interest rates start to increase as well. And a lot of people right now will know that that's exactly what's happening over the course of the last, I don't know, it's probably been happening for the last 3, 4, 5 months, but certainly over the last 2-3 weeks, mortgage interest rates have been increasing quite dramatically, and that is going to have an impact on people whose mortgages are coming due for renewal. But remember that most people are in fixes, so whether they're in fixes for 2 years, 5 years, 10 years, whatever it might be, it means that some of those people, they're not all going to come off tomorrow when the mortgage rate is going up. They'll come off over time, and so that impact might be a little bit more muted, but definitely something to be aware of. And then finally, what does that actually mean for property? Increasing interest rates means that there's, like we said, less disposable income. People have less disposable income. They've got more, things have got more expensive, and there are also more attractive alternatives in the short term. We just talked about the fact that the banks might be offering somewhere in the region of 4%, 3%, 4% for savings. But that is the short term. That's what we need to remember. This means that obviously fewer people want to buy property. Fewer people want to invest in general, but fewer people want to buy property. And if fewer people want to buy property, guess what happens to house prices? House price growth slows down. It doesn't mean that there's going to be a crash or a recession, but it just means that the growth in house prices slows down, or the prices start to fall a little bit. Now, if we're in the correction that I think we are rather than the crash, I think the point is that everyone thinks that there's going to be a larger correction than I do. And on that basis, people are thinking to themselves, actually, you know what, let's just hold off. So people aren't buying properties, people are not investing, people are not spending as much as they used to. And what that means is that the prices are going to start coming down a little bit, or the growth is going to slow, one or the other. Either way, what it means is that there's an opportunity. One of the questions that you might be asking yourself is, but why are we not seeing these reductions? We're not seeing, for example, a house that was on the market for £200,000 all of a sudden being sold for £150,000. Because again, we're seeing a correction. We're not necessarily seeing massive reductions in house prices. But the other reason as well could be that there's a difference between nominal house prices and real house prices. And let me just talk to you about what the difference is. So technically, prices are falling because if inflation is at 8.7%, but your house price growth is at, say, 5%, that means that in real terms, you're actually losing a couple of percent there. So in real terms, the house prices are falling. It's something that we need to be aware of. And then finally, it's difficult to notice the fall if you're not buying houses every day. I mean, the fact is that if you're going out and buying a Kit Kat every day, and every day you can see the prices going up, you're going to know that those prices are going up. There are 3 reasons there why you may not have experienced the falls in house prices that people are expecting. But this also decreases the supply of rental properties. If people aren't investing in property and people are not buying properties to rent, then the number of properties that are on the market reduces. That means that there's the same number of people who want to rent properties, but the number of properties is less. And so there's only one deal that can happen there, which is that rents are going to increase. And rents have increased considerably over the last 3 to 4 years. But I think that what we're going to see is that rents are going to increase a lot more in the next 2 or 3 years. I did a calculation earlier today, and the calculation showed that at a higher interest rate, so where we are today versus where we were, say, last year, the rent has to increase from £750 to £950, a £200 increase, which is a huge increase. But the question all then comes down to is, well, can people afford it? And I think that the answer is, as I just said, are people still going to the cinema? Are people still going to restaurants? Yeah, well, people are still going to those places. So I think people have the money in their banks. People have got pay rises, as we spoken about. So people can ultimately afford these higher rents, especially the people, the other day, if you've got a good property and it's a good quality property, then those properties are going to go far quicker than the slower, older moving stock. Although we're saying right now it's people think it's a bit of a dodgy time, really what's happening is that prices are, the growth is slowing, or the prices are reducing in value in real terms, but people don't realize this. And as a result of that, people are just scared and they're not getting involved with the property market. But if they're not getting involved, it means that they're not going to benefit from this increase in rents that's going to happen, and that increasing in rents is going to increase the yields. So the yields increase, and when the yields increase, obviously then that encourages people, that attracts people to get back into the market, and that then rebalances the spending saving bit that I was talking about earlier. And when the market slows down, there is an increase in rents and yields, as I mentioned, and when the market picks up, then there is an increase in house prices. And so this is the reason why people like property as investment strategies, because you win either way, ultimately. When the market, like I said, slows down, you get an increase in rents and you get an increase in yields. And when the market picks up, you then get an increase in house prices. So both ways you tend to win. And then finally, what does that look like? What does the future look like right now? First of all, in inflation. So actually, inflation in the US seems to have peaked at the moment, although the Federal Reserve is still looking at what they're going to do about interest rates, because they want to make sure that, this is not just a short-term peak and then it goes back up again. It actually stays there and then starts to come down again. In Europe, again, it looks the same. And in the UK as well, the same. So it looks like inflation has peaked, like we said, at 11% or something. And now we're looking at that we're heading on the way back down. We're currently at 8.7%. And we're looking like by the end of this year, we'll probably be at kind of somewhere around the 5% mark or thereabouts. And then actually what's going to happen next year, I think, is that we'll then come back down to sort of the 2% target, which is what the Bank of England Monetary Policy Committee want. In terms of the interest rates, in the US, it seems like they have peaked, and in Europe and the UK, we've almost peaked. So there's still a little bit of of interest rates increases still to go. In fact, in a couple of days' time, we're going to see it again, that interest rates are going to increase. And those interest rate increases, obviously what's happening in the news is they're being pulled across to sell newspapers. They're being pulled across to sell news by helping, I suppose, unfortunately, people understand, oh my God, or the worst case scenario. If these interest rates increase, then all of a sudden people are going to be, losing their homes, and you've got to be scared. And remember, at the end of the day, fear sells more news than anything else does. So that is what the newspapers will be pushing. And I think that what we need to do is we need to be mindful of course, we need to be mindful of the economy and make sure we don't get caught in there. But if we do have the funds sitting around and we know that we want to invest in property, it's not going to be doing anything else anyway, then we might want to be looking to get involved whilst other people aren't getting involved, because that is the time to pick up properties at a slightly discounted price, especially if we know that in the future the interest rates are going to come down. So actually, if we buy now, then actually the only way is up, because the prices are going to go up in the future and the interest rates are going to come down. So your yields are going to eventually increase with the higher rents. So then we talk about we were talking about interest rates, and we said that they peaked in the US, and we expect that they're going to be about 4.75%, something like that, in the next couple of weeks, next couple of months, and then they'll definitely get to maybe a bit more than that as well. So maybe even 5.5% by the end of this year. So we just need to be aware of what's about to happen. And of course, like I said, all the newspapers are going to be at it. So just bear that in mind. But the one thing that I want you guys to remember, and it's something that Warren Buffett said, he said, observe the masses and do the opposite. For those of you that are in a good place and you can withstand these storms a little bit, and you realize that, we don't want to just be fearful, we want to actually understand what's the impact on our lives, which hopefully doing this today is going to help you to do. You're going to realize that a lot of the time, what we have to do is observe the newspaper and basically do the opposite of what the newspaper is telling you to do, because the newspaper is trying to sell news. That's not what's actually necessarily going to happen. And what we want to look for is, where are the opportunities? So if people aren't going to be buying properties, then maybe that's a great opportunity for us to negotiate better prices on the properties that we want to buy. So there's lots of opportunities, and we just need to be aware. And the phrase to stick in your mind should be, observe the masses and do the opposite. And I think one thing just to remember is, every time you see a negative headline in the newspaper, is just go to yourself, oh yeah, that's for the masses. That's not for me. And I don't mean it in a way of we should disregard what's happening in the news. Absolutely not. We should be aware of it, but we should think to ourselves, where's the opportunity? How can we get involved? How can we take advantage of this time, of this market right now? And then what's going to happen to interest rates is that in 2024, I think we'll then come in sort of steadily down, reduce throughout 2024, 2025, and then we'll be at the kind of 3% rate in 2026. So we will get back down to probably not what we saw over the last decade, but slightly higher than that over the next sort of 2-3 years is my opinion. So what now is the time to buy, and the reason for this ultimately is because although mortgage rates are higher, as I said, rents are increasing. increasing and there is less competition, so you can save thousands of pounds on the purchase prices of properties. The second thing is that we're no longer expecting a massive crash. We're no longer expecting even a massive recession by any means. It's just media fear mongering. That's exactly what's happening right now. And the media is trying to keep us all from, they're trying to sell newspapers, actually, is what they're really trying to do. And the way to sell newspapers is through fear. Remember, the next thing is that the worst case scenario is that the property prices drop by, say, another 5%. And if they drop by another 5%, and you've bought a property at 10% cheaper than what you could have bought it for before, or what you will be able to buy it for in the future, then it doesn't really make that much of a difference. If the prices drop by 5%, but you've got a 10% discount, then actually you're up by 5%. So that is definitely something to bear in mind, especially because of the fact that purchasing a property usually takes, the due diligence on the purchase phase usually takes between 3, 4, sometimes even 5 months to go through. So that means that if we agree a sale, let's say we're now in June, so if we say we agree a sale in July, and then by August, September, October, November, and in October the prices dip, well, that's okay. We can always go back and renegotiate the price with the person that's selling it. We could say, well, look, the market's changed, here's our new price. It's up to them whether they want to offer it. So we do have a little bit of wiggle room. It's not just the case that once you agree to buy a property, that's it. You agree to buy a property, you've got a couple of months effectively to do the due diligence and to understand exactly what's happening to the market. And I think in that sort of 4-month process, the 4-month due diligence process, I think a lot of people will realise that actually we're not going to have a massive crash in the next few months. It's probably going to be a little bit more like a correction where people think, you know what, I'll just be a little bit more careful. And when I say people think I'll be a little more careful of where I'm spending, I really mean like the people who can't afford to do anything else. So the likes of people watching this will probably say, okay, well, I mean, I know they're telling me there's a recession, but I'm still going out for dinner and I'm still buying gifts for people, etc. And the last thing to remember here is that, remember, if not now, then when? I mean, the fact is that if you've got money sitting in the bank, what is the alternative? Yeah, you could put it into a savings account that's going to earn you 3%. But two things. One, it's for the short term. As soon as the interest rate go back down again over the next year or two, you're then going to be getting the kind of 2%, 1%, 0.5%. And you're going to then have to think about doing something with that money anyway. And if you're going to be thinking about doing something with that money in 3 years from now, when everybody wants to be investing in property, the prices are going to be 10, 20, 30,000 pounds more than they are today. Whereas if you get involved now, whilst people are not so much thinking about getting invested in property because they're a bit shaky on what the future looks like, now that you understand how the economics of it works, you should be able to understand that the future is bright, basically. And because we know that the future is bright, it's actually the perfect time to invest in property. Remember, the media sells news, and fear and panic sell better than stability. So that is one massive thing to remember. Second thing to remember is that the best time to buy property was 20 years ago, and the next best time to buy property is now. So in property, remember, you win either way, whether it's through the yields or whether it's through the property prices increase. And all of this data that I've just given you, all of this recording is going to be put out into our social media content as well, because from all the stuff that I've told you today, this is all not just me thinking about stuff. This is all fact. There's lots of graphs and stuff to back up all of the stuff that I've just told you. The fact is that the media is telling you that you should be scared and we should be fearful and that we're going to all end in ruin. But actually what's probably actually happening is that most of you would have heard the stock market is entering a bull market. We're up 20% on the at the bottom. So the stock market is up. Property prices keep going up, although there has been a reduction, not a reduction in the prices, but a reduction in the growth of the properties. And I think this is a great time to get involved. Anyway, that is my time. I've already gone over. If anyone's got any questions, then feel free to ask. Otherwise, it was my pleasure to go through that with you guys on this hot evening. And hope you enjoyed it, hope you had fun, and hope you learned something. Remember, the best time to buy properties was 20 years ago, and the next best time to buy is now.